everyone, and welcome to our lesson on credit transactions. I want you to picture this. You walk into the tuck shop at school. You don't have money with you, but the shopkeeper says, "Don't worry, I will write this down and then you can pay me back next week." You walk away with your snacks and the shopkeeper has just made what we call a credit sale. That's the world we are stepping into today. A credit transaction happens when goods are received now, but payment only takes place later. Businesses use special accounting journals to keep track of these types of transactions. Why? Because the money hasn't come in yet, and if they don't write it down properly, they might forget who owes them what. There are 4 important journals that we are going to look at over the next 2 lessons. For today, we are going to look at the Debtors Journal, or the DJ, which is used when a business sells goods on credit. And secondly, we will have a look at the Debtors Allowances Journal, or DAJ, which records goods returned by a customer or discounts given. The other 2 journals that we will have a look at next time is the Creditors Journal, or the CJ, which records goods the business buys on credit, and the Creditors Allowances Journal, or CAJ, which records when a business returns goods to suppliers. For this session, we will now focus only on the Debtors Journal and the Debtors Allowances Journal. By the end of this lesson, you will understand how to record transactions in both of these journals, how to calculate cost of sales when using a markup, and how returns affects these accounts. So let's get started on this very practical journey into credit transactions. Before we go deeper, we need to talk about the perpetual inventory system. The word perpetual means something that never stops, something that continues without end. In accounting, the perpetual inventory system means that inventory records are updated continuously. Here's what happens in this system. When a business buys inventory, the inventory account is immediately increased. We debit inventory to show that more inventory has been added. When the business sells inventory, 2 entries happen at the same time. The first entry records the sale at the selling price in the sales account. That's how much the business is charging the customer. The second entry records the cost of the inventory sold. This goes into the cost of sales account, and at the same time, inventory is reduced because the inventory are no longer in stock. Why do we do this? Because the perpetual inventory system allows us to know at any moment how much inventory we still have and what the value of that inventory is. Imagine being the tuck shop owner. At the end of each school day, you want to know how many packets of chips are left, how many cold drinks are still in the fridge, and what the total cost of all the stock is. Without a system that updates continuously, you'd only know this information if you count your inventory, which might happen once a month or even less often. With a perpetual inventory system, you always have up-to-date information. That's why modern businesses, especially those using computer systems, prefer it. It's accurate, reliable, and quick. Let's move on to markup. Businesses don't sell goods at cost price. If they did, they wouldn't make any profit. Instead, they add a percentage on top of the cost price. That percentage is called the markup. There are two ways to calculate markup. You can calculate it on the cost price, or you can calculate it on the selling price. The basic formula we are going to use is the amount that is given multiplied by what we want divided by what we have. Let's first look at how we will calculate the markup on the cost price. If the business has a markup on the cost price of inventory of 20%, the following will apply. The cost price will be equal to 100%. The markup will be equal to 20%, which means our selling price will be 100% plus 20% is equal to 120%. If we are given a cost price of 500 Rand and the business has a markup of 10% on cost price, how will we calculate the selling price? If we now follow the principle that our cost price is equal to 100% and our selling price is equal to the cost price plus the markup percentage, it will mean that our selling price is equal to 110%. So, the amount that was given divided by what we have multiplied by what we want is 500 Rand divided by 100 multiplied by 110. Therefore, our selling price is 550 Rand. If we are given a cost price of 600 Rand and the business has a markup of 20% on cost price, how will we calculate the selling price? If we follow the same principle, our cost price is equal to 100%. Our selling price will now be equal to 120%. So, the amount that was given divided by what we have multiplied by what we want is 600 Rand divided by 100 multiplied by 120. That will give us a selling price of 720 Rand. But now, what happens if we were given the selling price instead of the cost price? So if we were given a selling price of 770 Rand and the business has a markup of 10% on the cost price, how will we calculate our cost price from this? So let's follow our principle. Our cost price is equal to 100% and our selling price will be equal to 100% plus our markup, so 110%. Therefore, we take the amount that was given divided by what we have and multiply by what we want. So now we have the selling price. So the amount that was given is 770 Rand. Our selling price is equal to 110. So this time what we have is 110. So 770 Rand divided by 110 multiply by 100. Therefore, our cost price is 700 Rand. Let's do another example. If we were given a selling price of 960 Rand and the business has a markup of 20% on cost price, how will we now calculate the cost price? So, same principle. Cost price is equal to 100% and our selling price will now be equal to 120%. So, let's take the amount we were given, 960 Rand, divided by 120, so what we have, and multiply by what we want. We want the cost price, so multiply by 100. That will give us a cost price of 800 Rand. Now, let's have a look at how we will calculate the markup on the selling price. If the business has a markup on the selling price of inventory of 20%, the following will apply. Our selling price will now be equal to 100%. Our markup is 20%, which means our cost price will be 100% less the markup of 20%. So our cost price will be equal to 80%. Now, if we are given a selling price of 550 Rand and the business has a markup of 10% on the selling price. How will we calculate our cost price? So, same principle. Our selling price is equal to 100%. To get to our cost price, we need to say the selling price percentage less the markup. So our cost price will be equal to 90. So if we now go to our formula, the amount that was given divided by what we have, multiplied by what we want, we will say 550 Rand divided by 100 multiplied by 90, and then we will get a cost price of 495 Rand. Let's do another one. We are given a selling price of 750 Rand and a markup of 20%. So what will our cost price be? Same principle. We were given 750 Rand. We will divide that by 100, and our cost price will now be equal to 80%. The 100 minus the 20 will give us 80. So 750 Rand divided by 100 multiplied by 80 will give us a cost price of 600 Rand. If we are given a cost price of 495 Rand and the business has a markup of 10% on the selling price, how will we calculate our selling price? So let's follow our same principle and formula. We take the amount that we were given, divide it by what we have, and multiply by what we want. Our cost price is equal to 90 and our selling price is equal to 100 because we have a markup of 10% on the selling price. So the amount that we were given of 495 divided by 90 multiplied by 100 will give us a selling price of 550 Rand. Let's do another one. If we were given a cost price of 600 Rand and the business has a markup of 20% on the selling price, how will we calculate our selling price? We will do exactly the same thing. We will take the amount that was given, our 600 Rand, divide it by what we have, which is the cost price of 80, and multiply it by 100. So 600 divided by 80 multiplied by 100 will give us a selling price of 750 Rand. Let's look at our debtors journal, or DJ for short. The debtors journal is used when the business sells goods on credit. That means the customer signs a contract with the business to take goods now and then pay it at a later date based on the terms and conditions of the contract. That can be 30 days, 60 days, 90 days, or whatever this business decides. The source document we use for the DJ is the duplicate invoice. When the business sells on credit, it prepares a credit invoice. The original invoice is given to the customer as proof of the sale and of the debt. The business keeps the duplicate copy for its own records. That duplicate becomes the source document we will use to record the credit transaction in our debtors journal. We will use the following columns to record the transaction in the debtors journal. The date column, where we write the date of the transaction. The details column, where we write the customer's name. The document number column, which is the invoice number. Debtors control, where we record the total owed by the customer. The sales column, where we record the selling price of the goods sold. And finally, the cost of sales column, where we will record the cost of the inventory we sold. Recording in the debtors journal helps us keep track of how much debtors owe. And just as a reminder, a debtor is simply a customer who owes the business money. Let's have a look at a duplicate invoice together. It shows the date of the sale, the name of the customer, the invoice number, a description of the goods sold, the total selling price, and the amount payable. When we record in the debtors journal, we must match these details with the columns. This is important because the duplicate invoice is more than just a slip of paper. It is legal evidence. If there's ever a disagreement with a customer, this document proves that the sale took place. That's why accuracy matters so much in accounting. So let's record a duplicate invoice in our debtors journal. Sunny High School Tuck Shop sells goods using a 20% markup on cost. So we need to keep that in mind later when we complete the cost of sales column. But let's start with our first column, the document number. So let's find our document number on our invoice. At the top of the invoice, we see the name of the high school, Sunny High School Tuck Shop. On the left-hand side, we first see the address of the school. And on the right-hand side, we have an invoice number. So our invoice number is 1486, and that is what we need to record the document number. So in our document number column, we will record 1486. Our next column that we need to complete is the day column. So let's go find our date. Now, directly under our invoice number, we see the date as 6 August 2025. So we can go record that in our debtors journal. If you look at the name of the journal, it says Debtors Journal, August 2025. So for the date, we will only write down the day in the column. Let's write 6 for 6 August. Our next column that we need to go look for the information is our details column. For the details column, we need to record the customer name, or so if we look at our invoice, we have a customer name as Mr. Dlamini. So we will use the customer name and record that in our details column. In our details column, we will record the name of the customer, Mr. Dlamini. For now, we will skip our folio column. The folio column is used when the totals of the debtors journal is posted to the general ledger. For recording this transaction from the source document, we won't use the folio column. Our next column that we need to complete is our debtors control column. So that will be the amount our customer owes us. On our duplicate invoice, the next thing that we see is line items of the items we sold. We sold 10 packets of chips, 5 chocolate bars, 6 bottles of Coke, and 10 lollipops. And the total amount was 162 Rand 50 cents. Now that is the amount that Mr. Dlamini owes us. So we can go and record that amount in our debtors control column. In our debtors control column, we record 162 Rand and 50 cents. And the next column we need to complete is our sales column. We sold our goods for an amount of 162 Rand 50 cents. It's the same as what Mr. Dlamini owes us. So let's write 162 Rand 50 cents in our sales column as well. The last thing we need to record is our cost of sales, but the value of our goods sold does not appear on our invoice. We will need to calculate that from the information we were given, which is that Sunny High School applies a markup of 20% on the cost price. So let's go calculate. To calculate this, we are going to use our formula. The amount that we were given multiplied by what we want divided by what we have. So we were given a selling price of 162 Rand and 50 cents. Our cost price is equal to 100 because the markup is on cost. Our markup is given as 20% and our selling price is given as 120%. Our cost price will be equal to R162.50 divided by 120 multiplied by 100, which is R135.42. So let's go and record our cost price. In our cost of sales account, we will now write down the amount of R135.42. Well done! We have now successfully recorded a duplicate invoice in our debtors journal. Let's move on to our debtors allowances journal. Now, let's consider the opposite situation. Sometimes debtors returns inventory. Maybe the inventory were damaged. Maybe they ordered too many. Or maybe there was a mistake, like they received the incorrect product. So when goods are returned, we use the debtors allowances journal or DAJ. The source document for the debtors allowances journal is the credit note. A credit note is the opposite of an invoice. Instead of showing how much the debtor owes, a credit note reduces their debt. It's like saying, you don't owe me as much anymore. So if Mr. Dlamini returns goods to the tuck shop, the tuck shop will issue a credit note, and that return will then be recorded in our debtors allowances journal. In our debtors allowances journal, we will make use of the following columns: a document number to record the credit note number in, a day column to record the date of the transaction, a details column to record the name of our debtor who returned the goods, a debtors control column, a debtors allowances column, and a cost of sales column. On a credit note, we will be able to read the date, the customer's name, the credit note number, the details of the inventory that was returned, and the price at which we sold the inventory to the customer, because what is recorded there is the amount that we are refunding the customer with. The credit note is proof that our debtor no longer owes the full amount of the original sales transaction. It's official evidence that we made an adjustment. We received the goods back, and in the place thereof, we gave the debtor some credit. The first information we will need to record our credit note in our debtors allowances journal is the document number. So let's go back to our credit note and find our document number. On our credit note, we first note the name of the tuck shop, Sunny High School Tuck Shop. On the left hand side we have the address, and on the right hand side we have a credit note number. The number is 147. In our document number column, we will write down our credit note number of 147. Our next column to complete is our day column. For that, we need the date. Directly under our credit note number, we see a date of 7 August 2025. So we can go and record that. In our day column, we will once again only write the day of the month, which was the 7th. Our next column we need to complete is the details, and for that we will need our debtor's name. The name of the customer indicated on our credit note is Mr. Dlamini, so we can go and record that in our details column of our debtors allowances journal. In our details column, we now write down the name of our debtor, Mr. Dlamini. Once again, we will skip our folio column and move directly to our debtors control column. For that, we will need the selling value of the goods that were returned. So let's go to our credit note. On our credit note, we can see that Mr. Dlamini returned 6 500 milliliter bottles of Coke. The unit price was 10 and the total was 60 Rand. We can go and record the 60 Rand in our debtors control column. We will now write down the 60 Rand in our debtors control column, as well as in our debtors allowances column, since that is the total value of the goods that were returned by our customer, Mr. Dlamini. In our debtors control column, it reduces the amount that the debtor owed us. And in the debtors allowances column, we show what our sales will ultimately be decreased by. We need to calculate the cost of sales, since with the goods that were returned, our inventory that we have in stock will increase. We are given the selling price of the returned goods as 60 Rand, and we've already established that the markup is on cost price, so the cost price is 100, markup is 20%, and our selling price is 120%. Therefore, if we follow our formula, we will say 60 Rand divided by 120 multiplied by 100 gives us a cost price of 50 Rand. In our debtors allowances journal, we will record the amount of 50 Rand in our cost of sales column. And that is that. We have now successfully recorded a credit note in our debtors allowances journal. Let's end with a quick recap. A credit transaction is when goods are received now, but payment happens later. The debtors journal records credit sales, and the source document is a duplicate invoice. We also looked at how to calculate and record our cost of sales. The debtors allowances journal records goods returned or discounts allowed, and the source document is a credit note. Together, these journals give a complete picture of what a customer owes, what goods have been returned, and what the profit was on our credit sales. Thank you for joining me for today's session. Keep practicing these steps, and soon you'll be recording credit transactions like a pro.